and we're going to get started. Welcome to a webcast entitled ESOP Structure Case Studies, How to Meet Various Owner and Company Goals. My name is Tabitha Croscut. I'm an attorney with Steiker, Fischer, Edwards, and Greenapple. SFE&G is a law firm of 7 attorneys. We're focused on advising companies, business owners, and trustees on various ESOP-related issues involving transactions as well as ESOP compliance issues. And today, you probably logged in through our sister firm website, SES Advisors, a firm that handles other needs of ESOP companies, including transaction analysis and ESOP administration. So today you get to listen to the legal side, and what I hope to do is to expand your knowledge of some of the alternative ESOP structures that have been used beyond what people generally talk about in the leveraged ESOP, although we will briefly talk about the leveraged ESOP basic structure to give everyone some footing and some background before we dive into the more complex structures. So just a few administrative points. One, it would be great to make this interactive. I know it's hard doing a webcast. I can't see your faces. I can't tell if you're falling asleep or if I'm confusing you. And we are going to kind of walk through a couple of structures that are more complex. So if you have any questions, please feel free to put them in the chat line there and send them my way. I will try to leave 10 to 15 minutes for questions at the end. Right now, everybody is muted, so we don't have to worry about background noise. But I can certainly unmute at the end and see if we can take some questions. But if we're on a particular slide, especially when we talk about the structures that I'll be walking through, and if I lose you, please let me know and we'll walk through the structure once again. So please take advantage of the chat feature. So that's one. If I don't get to your question, I'm doing my best to multitask between the PowerPoint and the chat feature. But if I don't get to it, please email me afterwards or give me a call. I'd be glad to walk through it with you. The webinar, as you may have heard, I'm not sure if you heard, is recorded. So if you get lost or you just want to go back to refresh, certainly feel free. Should be up on the SES Advisors website. www.sesadvisors.com within probably 24 hours. So you can certainly go back and listen again. And just at the end, if you would please take a moment to fill out the evaluation form, I would greatly appreciate it. This is the first time I've done this presentation, so I'm certainly looking for some feedback as to improve it, make it more user-friendly and whatnot. So please take a moment if you would. And with that, I will dive in here. Like I said, the point of this is really to offer up some additional structures, but to focus on how the ESOP transaction meets various goals and objectives of companies and their owners. What I'm not going to do is I'm not going to dive into qualification requirements of ESOPs. We're not going to spend any time talking about how vesting works and the sorts of ongoing retirement plan benefit features of the ESOP. I'm really going to focus on the transaction, the stock purchase itself, and how those structures they change and morph to meet the needs of particular companies and owners. I'm not going to spend any time on repurchase obligation, but I certainly want to put that out as anybody who does an ESOP should be very well aware of the repurchase obligation that comes along with it. And I'm also not going to talk much, maybe very short, on valuation issues, another very important part of an ESOP transaction. What we are going to do is we are going to talk about just a really quick review of some ESOP basics. I'm not sure, what level of knowledge everyone is working from, but I'm going to do that just quickly. Then we're going to jump into the 101 ESOP transaction structures, and that is your basic structures that you normally hear about in the ESOP 101 discussions or review. Certainly the structures that when I meet with a company, I walk through the 101 structures. And then we're going to get into the real meat of the presentation, which is to take you through and describe for you the stories of a handful of owners and companies that I have particularly worked with in the last probably 2 to 3 years. These are relatively recent transactions. To walk through the goals and objectives of the owners and how the transaction, the ESOP structure, can help and meet those goals. And perhaps, one of these scenarios will strike a chord with you, and you might say, oh, that fits a scenario I'm looking at, and maybe I should learn more about this. So with that, we'll move along here. So ESOP basics. Again, real brief. If you're on this call and you don't know what the word ESOP stands for, then you probably want to log off now because we're going to get into some pretty complex designs here. But employee stock ownership plans are what we're dealing with. ESOPs are qualified retirement plans. They're subject to the rules of the Internal Revenue Code and the Employee Retirement Income Security Act of 1974, which is otherwise known as ERISA. And what those rules do is form the foundation of protecting the employees who are recipients of the benefits under an ESOP. So this is about as in-deep as I'm going to get with respect to the retirement benefit features of the ESOP. To say that the company is the funder of that benefit. Generally, typically, there are no employee contributions. There are plans out there, and we will hopefully get to one particular plan that I worked on recently in which we did use some, not employee contributions, but contributions that the company had made to a profit-sharing plan and then transferred over to the ESOP. It's the only qualified retirement plan that can borrow money, and that's what gives the ESOP its corporate finance features and allowing it to act as a buyer for company stock. And the employees don't own the stock directly. It's certainly one of the issues that some companies probably would prefer to see the employees owning the stock directly, and other companies would cringe. But in the ESOP world, the stock is held by the ESOP, and the employees are beneficiaries of this stock, but do not hold the stock directly. And of course, the ESOP is, as I said, a tool of corporate finance. So it's a great tax-efficient means of transferring stock ownership in a closely held company, or we're going to be speaking particularly about privately held, closely held companies. I'm not going to get into the public company space. And so most of the time, although there are exceptions, companies that are looking at using the ESOP are certainly using it as a tool of corporate finance. So we get both the dynamic of finance and securities and the finance end of the world, but you also have to worry about the retirement plan requirements when you're dealing with ESOP. So, like I said, not going into depth in terms of the requirements, but there are certainly a list of rules that apply in terms of the retirement plan benefits that employees receive under the ESOP. So why are employees popular? And depending on who you talk to, the question will be, are they coming back in? Are they more popular now, or are they losing popularity? It's funny, depending on who you talk to, whether they're popular now or they were in the past. It really depends on whether the person has come across an ESOP recently. But the popular advantages of the ESOP, one that most people are well aware of, at least those who know ESOPs, is that a seller can sell their company stock to an ESOP and take the advantages under Section 1042 of the Internal Revenue Code, and that is the ability to take the proceeds from a sale of stock that meets, again, another list of requirements that we're not going to talk in great detail about. But they can take those proceeds from the sale of that stock, roll it into what we call qualified replacement property, and potentially defer all tax on those proceeds forever. It really depends on what they want to do. Again, going to the flexibility of the ESOP transaction, a seller who is looking for that advantage does not have to be an all or nothing, could take a partial tax deferral or not, could actually take it on all of the proceeds. So that is one advantage, and that is in the C corporation context. Another popular advantage is that the company can pay little or no income, corporate income taxes, depending on whether the company is a C Corp or S Corp. And certainly the advantage that most people are well aware of is the deduction or the deductibility of the loan interest and principal on the ESOP debt. And again, depending on the C Corp or S Corp status of the company, that will determine the amount or the ability, I guess, of the company to deduct principal and or interest. And we'll kind of touch on these in a little more depth as we look at the structures. Another popular feature is the ability of the owner to remain in control. And certainly that term is amorphous and ambiguous. An owner, owner A could have a totally different definition of the word control than owner B. And so that's certainly a term that I discuss in great length with an owner who brings it up in the initial or ongoing conversation about whether to do an ESOP. But certainly control in the sense of the day-to-day operations of the company. There's control in the sense of vote, and that really depends on the structure and the percentage of stock being sold to the ESOP. But there are great advantages in the ESOP context in terms of allowing the owner and the selling shareholder to retain control over the company even after the sale of stock. Another advantage that maybe not all companies take advantage of, but the employees can become more productive, and there are certainly a lot of research out there. The NCEO, for instance, has many research evidence of the ability of companies to increase their productivity based on an increase or a focus on increased communication and participation by the employees within the operations of the company. And so companies that grasp this capability and this leverage in the ESOP will be able to harness the energy of the ESOP and allow their employees to become more productive members of the company's community. Owners also like the fact that the ESOP transaction and the purchase price has some predictability and fairness. So you might not get a purchase price that is synergistic, that is the top value that you could get from a third party coming in to buy the company, but you're certainly going to get predictability. You generally will know going into the transaction that your price as the selling shareholder is $10 million, and it's generally pretty predictable that you're going to get somewhere around that $10 million mark. And certainly the transaction in most cases is a structure and a timeline that is developed together with all of the members involved in the transaction. So it's not a situation where the buyer comes in and demands a certain structure or a timeline. So it is a transaction structure in the ESOP context. They're much more under the control and predictable for an owner. And that is important in some cases, and one of which we'll touch on as we get through here. The transaction structures are flexible, and certainly this can be overwhelming to owners at times. But there's the ability to sell all or a portion of the stock. It's not like a third party coming in, all or nothing. The owner can structure transaction in multiple steps, can sell a little bit now, a little bit later, or owners plural. They can sell over many years. And so depending on the needs and the goals and the objectives of the ESOP and the seller's goals, you may have a different result depending on how much they want to sell and over what period of time. And perhaps a 67-year-old would have a different desire and goals and objectives than a 45-year-old seller. And so the ESOP provides that flexibility. So one of the things I wanted to focus on with this presentation is why do business owners use ESOPs? So obviously we just walked through the advantages, and certainly those are going to play into why business owners use ESOPs, but I wanted to walk through a couple. And I'm going to bring the first 3 of these up, and I've got a whole list here. And you probably could offer up some additional reasons and goals and objectives for a business owner entering into an ESOP transaction and going that route instead of selling to a third party. Or allowing a private equity group to come in and acquire stock. But three primary goals or concerns, objectives that I have found with all of the owners that we work with is, one is legacy. They're very concerned about maintaining that legacy. They don't want to see a third party come in, take their customer list and dispose of the company's name that's been around for 40 years. That is of great importance to the owner, and that might even in some cases be more important than getting an additional $10 million on a sale. The second one is the employee concern. The sellers, or at least one of the sellers, is very concerned about their employees. Perhaps it was a company that began 15 years ago, is incorporated, and these particular employees who are still with the company 15 years later, 20 years later, are the people that, while they don't have ownership in the company, they have worked their butts off to get the company to where it is. And the owner understands that, sees it, and perhaps has even made promises to his management team that they will one day have some ownership in that company. And so instead of selling to a third party and perhaps losing jobs, the owner understands and sees the importance of the company maintaining its position in the community. And the third one that is very important is that control, going back to the advantage of the ESOP, whether that is controlling the day-to-day operations of the company or whether that is controlling the vote. Again, a more in-depth conversation is necessary, but the ESOP has the flexibility to allow the owner to maintain control, certainly day-to-day control, and lots of times, more of a voting control and from a bigger perspective, board control. So those first 3 are what I would say are almost always present in an ESOP transaction. Those are always objectives. Maybe I shouldn't say always. There are certainly instances in which that someone's not real concerned about their employees, but they like the tax efficiency of the ESOP. But for the most part, if you see those 3 objectives or concerns, then you pretty much should at least have the conversation about an ESOP. Another goal, obviously, is diversification. You have owners who have all of their assets wrapped up in these companies that is really who they are. They don't look at it as an investment. They look at it as their life. And at some point, they get a smack across the face and understand that, wow, I really do need to take some chips off the table, whether that be for their sons, daughters, other family members for the future, or whether that be because someone, their spouse, loved one got sick and they need to back off and do less with the company. But diversification is certainly a big one. I'd be lying if I said most owners aren't engaged with ESOP by the fact that they can avoid or at least reduce income taxes on the sale. Both the seller and the company, as I was just talking about the advantages in the previous slide, have the ability to take advantage of the tax efficiency of the ESOP. And so that while some transactions may be the leading objective, there are usually, it's one of those things that in any transaction, it's going to be looked upon favorably by the seller. Control of the deal structure, we just talked about the advantage of the ESOP in allowing the seller, the company, to really control what's going on with the deal, whether the deal is happening in a 2-month span or whether it's happening in a 2-year span. Hopefully not that long, but it happens. And how much stock is being purchased, whether that's 20% or 100%. It's really in the control of the seller. There are some companies who look to the ESOP not only as a means of transitioning ownership of the stock, but also look very favorably at the addition of a retirement plan for employees. In fact, some companies look to the ESOP for that very reason. It's really not for the transition of ownership, but more focused on the retirement plan aspects and the ability to make their employees owners through the ESOP, giving them the retirement benefit. And so it really depends on the individual company you would be working with. Again, the increase in employee productivity. There will be a couple of examples we're running through in which the guiding force, or one of the real leading reasons for a particular owner to move forward with the ESOP was not the tax efficiency of the structure. It was really the focus on the ability to incentivize his employees to become more owner active in the company. He wanted to incentivize them to become employee ownership minded. And so that was one of the top two, I would say, in his reasons and goals and objectives with implementing the ESOP. Another is they're not ready to go. You know, maybe the owner, he or she, is just not ready to leave the company, and they understand that, you know, combined with perhaps the diversification as a goal, they could diversify, they could sell to a third party, but they're just not ready to leave the company, and so they want to maintain that office and do some discussion still with the customers, and so they go the ESOP route. Value and purchase price certainty, again, going back to the advantages. You're not talking about a situation where the third party comes in, the buyer comes in and says, you know, I'll pay you $20 million, and then two to 6 months later you're talking about a purchase price adjustment because of something they found in the due diligence. While that does happen in the ESOP context, you know, to the extent that the seller and the company are upfront in their due diligence to begin with, and the purchase price that they're looking for is reasonable, it is unlikely that the purchase price will be changed by the time you get to the closing. So there's certainly some certainty in the purchase price. And a lot of companies just have no ownership transition alternative. We'll look at one example of a company that was going to close its doors. It wasn't because it didn't have an alternative in that case, but the ESOP was certainly a saving grace when it came to the management team's viewpoint of it all. Liquidity, going to diversification, certainly creating a market for shares without having the company be sold to a third party and have the doors closed anyways. And another reason that comes up is to get rid of unwanted shareholders, or perhaps not unwanted, but those who are no longer active in the company, and this is a more tax efficient, again, way of giving or buying the shares back from the seller rather than doing a straight redemption and using after-tax dollars. So one reason that a company, actually another reason, is to reduce a large number of shareholders. So maybe you have, I worked with a company that had around 150 shareholders, very employee ownership minded. They had given their employees the ability to buy shares over the years, and at this point, 150 shareholders later, they'd really like to get some more control back of the stock, and so they were able to do that through the ESOP and yet not change the culture of that company. It was still an employee-owned company. It was just in a different mechanism than straight stock ownership. It certainly makes the tax returns a little less complicated. And just to highlight, I get the question often of what is the typical ESOP structure, or what is the typical goal, objective of an ESOP, the seller to an ESOP. And I just want to highlight that there's a spectrum of owners. So you have transactions on one end of the spectrum where the owner is simply looking at the ESOP as a financial tool, it's tax-driven transaction. They are purely interested in the 1042 tax-deferred treatment. Certainly we bring them along to understand that there are employee benefits to this, but whether they take advantage of, spreading the word of ESOP and taking advantage of employee ownership culture, that doesn't always happen. So there are transactions out there in which it's purely financial motivation. There are others who, like I said, there were a couple examples we're going to look at where the employee owner mentality was key. And so maybe along with the financial features of the ESOP transaction, with those combined, they were willing and really wanted to move forward with the ESOP. And then there are the other ones that they just have no alternatives in order to get liquidity. There's no buyer out there. There's no family member to transfer the stock to. It really could mean the end of the company. And so coming across the ESOP as a tool was really a needed event. And then just a couple of ESOP transaction requirements, and these are really, really broad, basic requirements. I'm not getting into the details here. It's obvious. You need a willing seller. You need a seller who is willing to sell at an acceptable valuation. And this is key to ESOP transactions. We work with owners every day who think their businesses are worth, twice as much as they're worth, and we get to the table, we talk about valuation. We get the valuation, and they find out that it's worth half, and the deal's off. They're not doing anything. So you need a willing seller. You need someone who has a reasonable expectation of and a reasonable view of what the fair market value of their company is. Obviously the willing buyer, and that buyer is the ESOP, and fortunately it's a company-created entity, and so that's the easy part. You need a financing source, and we're going to look at the possible financing sources, and I have to add, you got to have a good ESOP attorney. And I add that just as a joke, but also in all seriousness, we come across far too many ESOP transactions in which the transaction, was done as a typical M&A transaction and failed to include the terms that are required for ESOPs. It goes back to my first slide in which I said the ESOP is the only qualified plan that can borrow money, and so there are obviously going to be particular terms that need to be within those loan documents. It's not a typical note that you would issue to the seller from the company, and so you need to make sure that you have someone on that transaction team who has some ESOP knowledge other than just being able to read the Internal Revenue Code. There are certainly pitfalls to be wary of, and so I'm not saying get rid of corporate counsel. I'm saying make sure that corporate counsel has good special ESOP counsel sitting next to them so that they can be sure that they're not going to set the company up for any major pitfalls and excise taxes. So make sure you hire that good ESOP attorney. Financing sources. One, obviously excess cash. If you're already an ESOP and you're looking at doing a second tranche, a second purchase, certainly if you accumulate cash in the ESOP, you can use that cash to buy stock. You may have excess cash in the company. We certainly run across companies who have a lot of non-operating cash flow, and so they use that in the ESOP transaction. There can be bank financing. Obviously, that was hard to find in the past year or so, but it's starting to be available. We certainly have done plenty of deals in the last 6 months in which the bank was willing to step forward and lend. The terms may not be what they used to be, but the money is available for good companies. The seller or the business owner themselves can be the financing source, and sometimes they prefer that. They prefer not to have the bank involved in the company because, you know what, if you're in a cyclical business and you know that one of these years you're going to hit the downturn, the seller can step back and say, you know what, I'm going to defer that payment until next year when I know that we're going to be back going up and have the cash flow to pay it. And then I also put on here a profit sharing transfer because we're hopefully going to touch on that structure. So you certainly, there is opportunity to use other qualified plan assets, although we typically stay away from that. You've heard about all of the terrible things that have happened in the past 5+ years with companies using 401k assets, for instance, in the ESOP. So we try to stay away if we can from that structure. So ESOP transaction structures 101, we're just going to look really briefly at the leveraged ESOP and the seller financed ESOP. So the leveraged structure that everyone should hopefully be familiar with is a bank is lending $3 million of cash in this scenario, The company is providing a note back to the bank. It's your typical financing structure. This could be a situation in which there was no ESOP. It's really just a loan from the bank to the company. The company is then going to lend that money to the ESOP. So then we have a note between the ESOP and the company. That is what we refer to as the internal loan, the ESOP loan, the exempt loan. There are a lot of names for it, but I will refer to it as the internal note. And the bank note is number one. The ESOP is then going to take the cash it received from the company, and it's going to pay that cash to the seller and get shares for the cash. So this is the leveraged ESOP transaction. I'm just going to pause for a minute and say, I don't want to lose anyone here. So please let me know as we're walking through these structures, because this is kind of where we're getting into the structures, and it can get a little confusing. So hopefully the animation here and the arrows will help keep things straight. But so here we have, at the end of the day, a note between the company and the bank, a note between the company and the ESOP, ESOP owing company, company owing bank, and seller going off and depending on whether this is a partial 30% purchase or a 100% purchase, maybe seller's still at the company, or maybe seller's in Florida golfing. Then we have just a quick slide to show you what happens after the fact, because this is where the deduction comes in. The last slide was to show how we buy the shares, but this slide tells you where the tax incentive is. So the company is going to make a contribution to the ESOP on an annual basis. That contribution will be deductible generally, and so the ESOP then uses the cash to repay the loan from the company, from the transaction itself. Now, the contribution to the ESOP from the company is very similar to the contribution made to a 401k plan. It is a contribution by the company to a qualified retirement plan, and so long as it falls within the limitations of the Internal Revenue Code, it would be a deductible contribution. That means that the dollars the company just received are pre-tax. They're not paying tax on, we'll say, the $100,000. And now it's using those pre-tax dollars to make the payment to the bank. So you can imagine the dollars that are being saved through the deduction. And these are they can be different dollar amounts, but generally you can see them being the same. So the dollar amount that's paid from Corp, say $100,000 to the ESOP, the ESOP pays back the $100,000, so you don't actually have cash remaining outside of the company. It comes right back in and goes to the bank for payment on that note. Now, in the seller-financed ESOP, what we just talked about was the bank financing situation. The other, I'll call it basic structure that we've seen a lot of in the last year or two, is the seller-financed ESOP. So when the bank is not lending, or maybe you have a piece of bank financing, but you want to finance the rest with the seller note, what we do is we get rid of the bank, and the seller becomes the financing source. So the seller then is the one that takes a note from the ESOP, and the shares go to the ESOP. The way that seller note is repaid is really the same thing we just saw in the bank financing structure. The company is making a contribution to the ESOP, and the ESOP is then paying the seller. It's the same thing we saw in the bank. The company is using that money. It's a tax-deductible contribution to the ESOP, and instead of it going back to the company, it's just going to the seller to pay off the debt that would otherwise be held with the bank. So again, using pre-tax dollars to acquire the stock. So now that we have the basics, we have the bank financing structure, and we have the seller finance structure. We're going to jump into the alternative ESOP transaction structures, which a lot of times will comprise both of those. And what I'd like to do is basically talk through probably 4 to 6, depending on how much time we have, different transactions that I have been involved with and closed in the past few years, and give you just a sense of what was going on, more than just the structure, but why did the ESOP come to the table as an alternative for the owner versus selling to a third party. So the first transaction, I'll say, was in Boston, Massachusetts. We're talking about an S corporation, and there were two owners. There's an owner that had 25% and an owner with 75%. One of the owners was very, very involved in the day-to-day, and that particular owner actually is the one that brought the ESOP to his partner as a potential transition tool. The other owner, the 25% owner, was still involved in the company, but was much less involved. Was still working with the company. The 75% owner was, president, was on the board, making all the large decisions and making sure that there was a management team being groomed to take over one day. This is an engineering company, and the owner's goals, when I talked to him a couple of years ago, the goals were to diversify, and actually this was an owner who was working with an exit planner, something that is kind of a new space that has been developing, this exit planning professional who talked to the owner, walked the owner through his options in terms of diversifying or transitioning his ownership. And the owner was actually presented with an opportunity to sell the company to a third party. But if you look at the rest of his goals, the sale to a third party, although it looked good, it didn't meet the other goals. So that owner was particularly interested in taking care of the employees who had been at this company. And was very intrigued, in fact, by instilling a mentality of employee ownership in his employees. He looked very favorably upon the ability to use the ESOP as an incentive to get his employees to think more like owners and less like employees. And certainly that is something that happens over a period of time. It doesn't happen overnight, and it certainly doesn't happen the minute you adopt an ESOP and implement an ESOP transaction. But certainly if you put some energy into it and do the right sorts of communications, you can get there. And there are great examples of companies that have had great success in this. So this owner decided that he was more interested in looking at doing the ESOP versus selling to a third party. And the last thing in his mind was looking at the tax efficiency. But as we walked through the transaction, and as the weeks went by, and he started to learn more and more about ESOP, the tax efficiency actually made this structure using the ESOP a little more complex for him. And there were conversations in which he would say to me, how can there be so many options? And so one of the points that took a very long time to figure out was how much stock were the owners going to sell? They decided in the end to do a 25% sale for $2 million. Both of the owners sold a portion of their shares, both retain a piece, but they really were only interested in diversifying, getting a bit of money off the table, and certainly did not want to leverage the company to the point of going out of existence. That didn't serve anyone's purpose. And so they stuck with this 25% sale, and I got to tell you, it took a while for us to figure out what the right number was. So in this particular transaction, we really stuck with the basics. We stuck with the basic leverage transaction. We talked a lot about doing seller financing, and I think it was probably only a month before the transaction closed when we decided not to do seller financing to get additional money off the table. But we did bank financing, and it was a 7-year note. The sellers guaranteed the note from the bank or to the bank, and there was also some other requirements, including a security interest in all the assets of the company. The company then loaned that money, the $2 million, to the ESOP, and there was a note there, and I think that note was probably a 20-year note, 15 or 20, I don't recall offhand. So it doesn't match the bank note. The bank note was 7. I think actually here the note was 15 years, but they fully anticipate that they will pay that note off quicker. And the great thing about the ESOP note is that you certainly have every ability to repay that faster. The faster it's repaid, the faster that the stock becomes allocated to the participants. When you're dealing with 25% purchase of stock in this company, allocating stock faster is not going to be a detriment or a cash flow crunch for the company in terms of repurchase when they have to make distributions to employees. Now, when they do a next purchase, which I fully anticipate they will do once they have repaid this $2 million to the bank, and I fully anticipate this company will be growing and increase in value significantly by the time they do the next transaction. But at that point, then you think a little bit harder when you're going to a larger employee percentage, ESOP percentage ownership. Then you have to think a little harder about how quickly you want to pay off the ESOP note. But here, they certainly anticipate paying that off, 25% purchase for $2 million and faster than a 15-year term. So going back to the structure, the ESOP is then using the cash to buy that 25% of the shares of the company. And just for additional information, this, on the bank financing, the terms were 30-day LIBOR plus 275 basis points. So not terribly bad. So that was the Boston, Massachusetts, very basic, typical leverage structure. We're now going to move to Westchester. I'm not seeing any questions, so I'm going to assume that we're all still on the same page. Everybody's following. This is a company, and this is the story I alluded to. This is a company, one owner, 100% shareholder, obviously, S corporation, a manufacturing company with an engineering focus. The goals here were significantly different than what we're used to seeing, and that is the owner here was in a situation in which it was a second-generation owners. He and his brother owned the company in Westchester, and the owner that sold to the ESOP here, he wasn't particularly interested in working for another 10 years, 5 years, even 2 years. But he couldn't close the company down because his brother did not feel the same way. He wanted to keep working here, and so they continued. Well, unfortunately, about 3 to 4 months before the transaction was done, the ESOP purchase, the brother who was the one interested in the business passed away. He had been fighting cancer for a while, and upon his passing, the other brother decided he was no longer interested in maintaining this company and was ready to close it down. The worst part, I guess, for the management team is that even though there was a buyer knocking at the door, there was a third party ready and willing to buy, this owner, I think that the death of his brother was just enough. He just wanted to get on with his life and enjoy himself. He was a wealthy man, had no interest in continuing and dealing with due diligence and negotiation of a sale to a third party. So he actually called all of his employees into a parking lot because it's kind of where he could get everyone together, and told them that the company would be closing its doors. Fortunately, the CFO of this company, in conversation with a family member who worked at an ESOP company, said, well, why don't you look at this? This could save this company. You guys could do this. Because the management team, as usual, did not have the financial capability to come up with the money to buy this company. They certainly weren't going to be able to go to the bank and borrow the money to buy it from the owner. And so they looked into the ESOP. The owner thought, you know what, this will work. And with the addition of the ESOP in an S corporation with 100% sale, the company was also going to be able to avoid or it would not be paying any federal income tax. So it would have additional cash flow to pay the owner faster. So the goals for this owner were to cash out. He just wanted out. He didn't want anything else to do with this company, which is somewhat sad given the history of the family ownership. But he was willing to give it, a couple months to allow the management team to put the ESOP in place as a tool to keep the company going. I think there was around 50 to 75 employees that would have lost their jobs. And again, it was a profitable company. This wasn't a company that was having hardship. So we did a transaction, 100% sale for $6.5 million. It was a rather quick sale. And the reason, in addition to the fact that this was a little different in terms of the goals and objectives here, the reason I added this one in is because it used a transaction structure that we use an awful lot, but I don't think we talk a whole lot about, and that is, in the S corporation, the goal is oftentimes to have, at the end of the day, a 100% employee-owned company. So in an S corporation, you're not worried about the seller tax advantages of a 1042 tax-deferred treatment transaction, so it doesn't matter who the seller is selling to. The transaction of the seller selling the shares would be taxed. So in this S corporation and in a lot of others, the seller sold directly and the company purchased or redeemed, is what we call a redemption, redeemed the shares from the seller directly for $6.5 million note. And then the ESOP simply acquired new shares from the company for $1.5 million note issued to the company. And to add a little color to this, the ESOP note was a 20-year note. And the reason for that, again, we have a 100% ESOP transaction. At the end of the day, the only thing left here is the company owes a $6.5 million note to the seller, and the ESOP owns 100% of the stock. And so over a 20-year period, the ESOP will allocate its shares to all of the employees, and they will then, at the end of 20 years, have fully allocated to their accounts, hopefully a company that is in excess of $6.5 million. Additional color is that the seller note here, the $6.5 million note to the seller, carried an interest rate at 1.94%, which I believe was the AFR, the applicable federal rate at that point, the lowest rate, and had a 5-year term. So, this is just evidence that this owner was not looking for, the best deal. He certainly could have gotten an interest rate that was higher than 1.94%. But he's more worried actually about getting his payments faster. So we were anticipating that this seller would be paid in full within about 18 months to 2 years. And I think they're well on their way. The other bright line here is that the company, again going back to what I originally said, had a buyer knocking at the door. So to the extent that that buyer actually remains interested, you have a company with 50 to 75 employees who are now going to see the proceeds from a sale to a third party if that actually takes place. So a win-win situation, assuming that they also don't lose their jobs, but at least they would have some cash in their pockets to get by for a little while. Looking for questions, I don't see any, so I'm gonna keep going here. The next one, a company in State College, Pennsylvania. Here, met with one particular owner who was looking at ESOP, one of the most educated owners I had worked with in a long time in terms of his ESOP knowledge. He had done his homework for sure before I met with him. He almost probably knew as much as I did about some of the technical issues, but we certainly taught him a lot throughout the transaction. He was looking to deal with an inactive shareholder. This was a C corporation, so the last two companies we talked about were S corporations. This one's going to be a little different. It's a C corporation. It's an engineering company that's involved in the mass transit space, and the goals here, although not that much different than other companies, still guiding how we structure the transaction, how much stock was sold, how the transaction was financed. The story behind this one is this is a company that the three original owners, shareholders, originally worked for a large corporate company. They kind of got sick of the corporate mentality, corporate bureaucracy, and decided that they were going to take a division that the company no longer wanted to invest in, they were going to take a division and make a go of it. So they left the company, a rather large company, started working out of one of the owner's basements, and over time have developed that small piece of work into a very thriving, valuable company with probably 50, I think 50 employees at this point. A great company, great people, and this is a company that they already had that the family type mentality around their employees. This is not a company that's going to sell to a third party. They're a very close-knit group. Their concern was, again, one of succession planning in terms of they had this one inactive shareholder. They needed to figure out what to do with him. The owner that I met with, who kind of put together this option for his partners, he was certainly looking for diversification. He wanted to build a big house and needed some cash. So this was a great tool for him to get a little cash in his pocket. And the third owner was interested in a tax-free rollover. Again, this is a C corporation, so it offered the 1042 tax advantages. The third owner, who stuck with the company about a year to two after the transaction, but was only staying on to groom his successor, and then was getting ready to take off to enjoy retirement. So this served a lot of purposes, filled the objectives for all three owners who were in three different places in their lives, and certainly was, I can tell you, looked upon favorably by the employees. This was a 35% transaction for $5.6 million, and again, this one we used two different things here. We used two different structures. The bank finance of $1.3 million, and I'm just going to run through this really quickly. It's the same thing, your leverage transaction. All three of the sellers got some amount of the cash that came from the bank. And then the second part was a seller finance piece. They couldn't get any more than 1.3, or they didn't want to get any more than 1.3. Actually, in this particular situation, they were very financially educated, and they kind of run the numbers and knew they could get a better deal getting the interest paid to them versus paying it to the bank. So we did a second piece of this with the seller financing, $4.3 million in seller A getting a $2 million note and seller B getting a $2.3 million note. The bank financing here was a 7-year note. It was either, and I'm not sure which they chose, but either a fixed interest rate of 6.5% or 30-day LIBOR plus 375 basis points with a floor of 5.25. This was a couple years ago. They definitely wanted the remaining owner and his wife to guarantee the debt, and they looked for a security interest in all assets of the company. And this was a service type company, so they were really, the bank was really fixated in getting the guarantees from the owner. Subordination agreements. The seller notes were 12% interest rate, but part of the reason for that was they couldn't get, it was more like mezz financing. They weren't going to be able to get that much more from the bank. So the sellers were certainly subordinated to the bank. And the other key here was the company was looking at paying the sellers back much faster than what the term of the note was, which was 10 years. Those seller notes were 10-year terms. And so the 12% was their way of getting, incentivizing the company to pay them off quicker. The trick here was we don't like to have seller notes with the ESOP because there are limitations on what the sellers can get in the event of a default. So instead of holding the note with the ESOP, we assigned the two sellers who had notes assigned their interest in the note to the company, and then the company issued them a note. So at the end of the day, the sellers still held the note for combined $4.3 million, and the ESOP was paying the company instead of the seller, so it just kind of cycled through. And so this is what the resulting finance structure looked like. You had a debt to the lender, and you had two notes for the combined purchase price between the ESOP and the company, and then the company owed the sellers. So that every time the company made an installment payment on the ESOP notes, that would be tax deductible, and then the company would make the corresponding payments to the bank and to the sellers to shield that, to allow for pre-tax financing. All right, I've got about 5 minutes here, so I'm going to speed up a little bit. This is an interesting structure. I'm hopefully not going to lose you on this one. I just put this one in because it involves an LLC. So we have a family-owned company, a father who started the S Corporation years and years before the LLC was formed. LLC was formed with 3 owners, and the 3 owners were the father, the mother, and the daughter. This is an engineering company. The goals here were your typical family-owned company. There's no one to transfer to in terms of transferring the stock. They were looking for liquidity. Dad's father recently passed away and kind of woke Dad up to the fact that he needed to enjoy life. So he was looking to spend less time with the company, more time enjoying life outside of the company, although he definitely loves the company, looking to avoid tax to the extent they could. Again, this is an S corporation context, so they can be tax-free from a federal income tax perspective. And they were very concerned about their employees. This was a 100% S Corp transaction for $18 million. The interesting tweak to this one, first of all, we had to incorporate a new entity to bring the S Corporation and the LLC within a control group with the holding corporation. Then the owners of the LLC, the 3 owners of that LLC, and the 1 owner who is the same in the LLC, but of the S Corporation, they sold their units. So the stock of the S Corporation, the membership units in the LLC were sold to the holding corporation in a taxable transaction, and they received notes in consideration of their sale. Those notes are taxed in the installment sales treatment, so every year they pay tax on the installment received. So then you have the sellers holding $18 million aggregate in notes. And you have the new holding company within the control group of the LLC and the Q-sub. And then the ESOP then buys new shares from the holding company to make that control group of companies a 100% ESOP owned, then avoiding by the tax-exempt nature of the ESOP, not paying federal income tax, and being able to pay off the $18 million of seller debt in much faster pace. All right, we're getting here. 2 minutes left. This is the transaction I alluded to in terms of the profit sharing. A little complex. So at this point, I'm just going to skip here to the end so you can see some context information. We are only missing out on 2 transaction structures here and 2 pretty complex. So, all right, get to the entire end. So at this point, I'm going to unmute the line, and if anyone has any questions, I would love to hear them, if I can figure out how to unmute.
The conference has been muted. The conference has been muted. The conference has been unmuted.
All right.
Tabitha?
Yeah.
Yep. Hi. I just had a couple of... Hi. It's Joe Moran. I just had a couple of questions. I'm kind of new and I'm learning this, and we're an investment banking firm that might use this as a an alternative in future transactions. But I just want to confirm some of my I guess suspicions. Companies with a high growth rate are probably not good candidates for ESOPs, right? Because they're hard to value going out 2, 3, 5 years, right? And at the same time, cyclical companies too. They must be tough for ESOPs as well too. If you're having banner years and then 3 years later you're getting crushed as a result of no fault of your own, but just kind of the economic environment that we live in, which we know is cyclical.
Yeah, I mean, I think it depends on, when you say they're going to get crushed in certain years. Certainly, there are a lot of companies that we work with that are cyclical in nature, and I think it's really just a matter of again, going back to structure, making sure that the terms of the notes, the financing, take into consideration that cyclical nature, and you can really build in the flexibility to make sure that in those down years that the company is able to still make its payments, and the ESOP doesn't take it under just by the fact that it has an ESOP. I would say that most of our companies do have cycles and expect that to happen. Certainly, if there's a huge, what's happened in the past couple of years here, there's a huge downturn in the economy, that's not something that, you can anticipate. But to the extent that the companies are, they know there are going to be cycles of up and down, you can build that into the financing structure of the ESOP.
Right, the bank covenants and such like that will do that.
Yeah, absolutely. I mean, it's really it's a matter of being cognizant of what the company can handle from your bank covenants, and to the extent that you've had a relationship with a bank historically, that's kind of the best bank to go to and say, look, this is what we want to do. They're going to know, they're not going to let you over leverage, first of all. And even in that instance, you might look at doing more in terms of seller financing, because there's a reason why a lot of sellers say no to the bank, and they offer up the financing, because they know in those down years they can say to the company, just hold this year, I don't need to be paid, I'm not going to declare default on my note, just wait until next year and pay me double.
Right.
So those sorts of things. In terms of your question about, a company that's growth rate is on its way up.
Yeah. Really accelerating. It could be a software company or a business services company that's showing tremendous growth.
Sure.
It's probably a strategic move on the owner's side, but very hard to value, I would think.
I think it goes to the question of why are they looking to sell, and why would they be looking at ESOP? Certainly, we've had those instances, and you can value every company. The question is whether the seller is willing to accept that value, right?
Right.
So if it's a situation where the company is certainly growing quickly, startups, you don't see ESOPs in startups.
No.
But if it's a company that they're getting into a new market and things are looking up, the Boston company, for instance, things were looking really good for them, and I think that's part of the reason why they only sold 25%. They didn't want to lose out on the upside, in 5 years.
Right.
But it goes back to kind of the goals of the transaction, and I think if they're looking for liquidity, for instance, one of my sellers just wanted to build a house, and all of his assets were in the company. This met a lot of different needs for him, and so doing a small purchase got him some cash, and he didn't lose the upside on the rest of his ownership.
I understand. Now I have a few more questions, but I don't want to monopolize your time. If there's others, I can come back, but I'll let them go.
Sure.
Tabitha,
Yep.
This is Bill McIntyre. I just wanted to make sure that was his name Al, the previous questioner, was aware that the difficulty in determining a valuation is not an issue with an ESOP, because the valuation has to be determined essentially by an independent, objective, outside, qualified, experienced valuation advisor.
Right.
So it's and that valuation advisor advises the ESOP trustee in terms of what the maximum valuation is that the trust can pay, that the ESOP trust can pay for the shares. So difficulty in determining a valuation is simply not an issue at all.
Yeah, I think Bill, it's more a question of whether you can give appropriate projections to the evaluator, without with a company that's increasing, so rapidly that they just don't know how good it's going to look, and so I think it goes back to a question of is the seller willing to accept the value that the independent valuation firm puts on the company?
That is, yes.
Yeah. So that's
always difficult, yeah.
Yeah. Thank you, Bill.
Okay. I got to run, Tabitha. Thank you.
Yep.
Tabitha?
Yes.
Hi, this is Toby Castavana. How are you?
Hi, Toby. Good.
If, in fact, you've already done a transaction for a part of the company, I'm sure that the subsequent transactions don't have to be the same type and form, but what does that do in terms of employee education?
I think in terms of a second transaction, most of the time I would say it's customary. Let me step back. The first question is, for the employees, they're going to be worried about value because a second transaction is going to add debt to the company, and so it's going to drop the value of the company. Okay. So typically, they're gonna be getting more stock, obviously, but the value that they see on their benefit statements is going to be lower for a period of time. Now, depending on how much that second transaction, third transaction, fourth transaction is for, will indicate how long the value is lower. But customarily, we will, the trustee in the transaction would require price protection. So they would require that, at least for purposes of people who are retiring or those who unfortunately die or become disabled during a certain period of time, their stock that was currently, prior to that second transaction, in their accounts would be paid out at the pre-transaction fair market value. So they would be protected. But it really is just a matter of communications and making sure that people understand, that employees of the company understand that they're actually getting more benefit through the next transaction. But you have to educate them on the financial side of that.
Okay.
Thank you.
Absolutely.
Tabitha?
Yep.
Yeah, is there going to be either a replay of this presentation or a copy of the presentation deck available for us?
Yes, this presentation has been recorded and will be on the scsadvisors.com website within the next 24 hours. So you will be able to go back and review it.
And the slideshow, Tabitha?
Yes, it will be on there.
Okay, great. Quick question, Tabitha. If you have a small ESOP, what is it, 14 or 15 employees you need to kind of meet that requirement, right?
Well, in the S corporation context, 14 or 15 is a small number.
Yeah,
we prefer more than that. In the C corp context, you could have 10, but that would be a pretty small ESOP.
Okay. My question is what if you had like 4 major employees that wanted to be kind of the controlling guys of the ESOP? It doesn't have to be equally weighted, does it?
The allocations in the ESOP are based on compensation.
Oh, okay. Okay.
Yeah.
So if they were the key employees, they would probably be the top.
They would be the top
compensated, right?
Yeah. Unfortunately, we didn't get to the slides. That there was actually a transaction I did recently that I put on here. The management team that had about $1 million in their profit sharing account.
Yeah, that was the Doylestown, Pennsylvania one.
Yeah, yeah.
I want to watch that. Yes. Mm-hmm.
Okay, they actually transferred their profit sharing accounts to the ESOP and bought stock through their, and it was offered to all of the company's employees. So not just the managers, the exec team, but everybody could transfer their profit sharing money. And so anybody who did that got stock. But then they would get their additional allocations from a normal ESOP leverage structure. Understood.
Now, when they go to the bank, I know it's the corporation that borrows from the bank, and then the diagrams that you showed. Are there any personal guarantees sometimes required by the banks? Absolutely. There are. So even though the corporation would be the borrower. There are personal guarantees required as well.
Yeah, especially in a company that doesn't have hard assets, but even in an asset-based lending situation, the banks are generally looking for some sort of personal guarantee. Now, I have come across a few instances in which there was an ongoing, really good relationship between the bank and the company, and they were able to get away from that. But generally, you will find a request for personal guarantees.
Gotcha. Thank you.
Yep. Anybody else?
I hate to monopolize it. One other quick question.
Yeah, sure.
When you say it's pre-tax contributions with the ESOP, but there is income tax considerations for the seller, right?
Yes.
Yes.
Unless they're doing a C Corp 1042 transaction.
Which has already been taxed, right? Exactly.
So,
in an S Corp, the proceeds to the seller are his personal taxes, right?
That's right. That's right. And then you have the instance in which you have sellers trying to determine whether they should pay all of the tax up front, like this year, knowing that it's 15%, whether they should pay it this year and elect out of installment treatment, or whether they're just going to roll the dice and pay as they go.
Gotcha.
Yeah. Anyone else? All right. Thank you for your participation, and please take a minute to fill out the evaluations. The presentation will be available at sesadvisors.com, and I look forward to seeing you on our future webcast. So have a great day.
Thank you.
Thank you.
Thank you. Please stand by.
Premiumbeat.com